Hello, everyone, and welcome to the 2025 Klaas Financial second quarter client webinar. I am Eric Schwartz. I'm one of the advisors up in our Madison office. I'm joined here in Madison by Josh Stirling, our Chief Investment Officer. And then remote from our Loves Park office, we have Kite, one of our advisors and our Chief Financial Officer. Thank you all for joining us. As we always do, before we jump into the content for today, which I think there's just a few things maybe to talk about since we saw you last.
Just a handful. We're certainly a lot lighter than last time.
This is true. This is true. We would just like to do a quick overview for anybody new jumping on with us today. A quick overview of Klaas Financial. So we are coming up on our 50th year in business in 2026. So we'll have to do something to celebrate that. We are a registered investment advisor. We have two offices, one here in Madison, Wisconsin, and one in Loves Park, Illinois. And from those two offices, we serve almost, 1,062 households. And while we are just located in 2 states, we work with clients in 32 states. So we have folks all over the country that we're working with. We, as of today, have 23 employees, and we manage just about $757 million on behalf of clients. So just a quick overview, like I said, for anybody new, and we can jump into the content here.
Yeah, I feel like all those numbers have been slowly increasing over time. It wasn't long ago that we had less than 20 employees. And
right?
So, yeah, it's been really wonderful.
We get a quarterly check-in to see where it is, the three of us at least. All right, well, Josh, you were going to kick us off with just some updates on what's been going on in the market since we talked to everybody.
Yeah, well, last time we had a lot of interesting things to talk about. We got to chat about the Liberation Day that had happened right at the end of the first quarter, coming into the second quarter. We actually had to update so many slides because the drop in the market happened just after the quarter end. And so we're looking at kind of the recovery of Liberation Day on this slide here. So taking a look at the slide, we're looking at kind of the drop in the market and then the recovery back in the market. We're looking at two different items here. One in the green, that is the S&P 500. That's typically what everybody's listening to every day when you're hearing news stories about, oh, the market's down 1%, 1.5% today, or up 2% the next day. That's typically what you're hearing about in the market. The blue line that we have on the screen, that is what we like to call our 60-40 portfolio, 60% globally weighted equities, and then 40% aggregate US bonds. And so we want to show that here. And we talked about this last time a little bit because we wanted to show, well, one, the recovery in the US equity market specifically, which has been rapid and pretty impressive, I'd have to say. But then the secondary reason we wanted to kind of show this is what most of our clients actually experienced along the way. So first of all, just kind of talking about the quick recovery that we had. When we all last chatted, it was just before May. And so on the screen, we have both marked Liberation Day, and then we also have the Klaas 1 webinar, or Klaas Q1 webinar that we have there. And you can see that we were in the midst of recovering a little bit, but I mean, the markets were still pretty upset. And we were still focusing back on, hey, we're down, but still recovering. For most of our clients, you can see there, they had actually already recovered from that recent market fluctuation. But little did we know that we had a pretty big rebound coming in along the way. So down from the down market, you can see that the green line for the US equities started to go down in the beginning of March. But by mid-May, beginning to mid-May, we had already recovered from there. And as you can see at the end of this last month, June 30th, both our 60-40 portfolio and the US stock market were up pretty significantly on the year. Again, we're having another pretty substantial year in the market, but we did have a brief kind of scary moment there. So the secondary thing that I talked about is that what our clients experienced was not really what the overall market experienced. And we can see that our 60-40 portfolio at worst was down about maybe 6.5% on the year-to-date value. But you can see there that at worst for the S&P 500, it was down 15%. Even so, the Nasdaq, which is mostly a technology, the top 100 tech stocks in the market, that was down 21% at worst. But the whole point of what we do here is to help clients invest in a fully diversified portfolio that not only benefits from the equity market growth over the long time, but also helps balance it out for tumultuous markets like we just saw at the beginning of this year. And it really was a huge benefit to a lot of our clients. Eric, I know I talked to you, Kyle, I talked to you as well, and a handful of our other advisors, but we have clients coming into meetings saying, all right, give me the news. How bad is it? And we say, what? You're flat on the year, or you're actually up 2%.
Right. It was one of those moments where I have a fair number of clients who say, boy, when it gets really volatile like this, I just don't look at my statements. I just don't open them. And this was one of those moments where it's kind of like, well, I wish you would, because it might make you feel a little bit better. But one just point of clarification, I think everybody knows this, but I'm going to clarify. When we say Liberation Day, that is the name given to the day that the federal government announced what they called their reciprocal tariffs. And it sort of sent the market into a tailspin for, as we can see here.
Couple of days.
Yeah.
So yeah. But a period of 5 days where it seemed pretty scary for a hot minute. But I think these are important times to look at it and kind of look at our emotional response that we have to some of these events, because I can tell you when those days came up, looking at it from kind of the professional side, it's well, like you don't necessarily know exactly how things are going to play out, what's going to happen. And that could be a little scary, not knowing when the bottom might be. But looking at these events, it's important to pause and say we need to remove the emotions, kind of what our gut is telling us in those moments, because these things happen consistently. Every 2 to 3 years, we can have a down market of about 10%, maybe even more, like we saw during this time. But history shows that recoveries do happen. It's just a matter of time. And luckily, in this case, it was only a matter of about a month before we came right back to break even in this case. And
I think this really is going to speak to, and I know you're going to talk about this more in a moment, speak to the value of diversification. And I'm really glad you pulled out here, at worst, that 60-40 portfolio. So again, that's kind of our standard retiree portfolio, I think you can say. That was, down in the neighborhood of maybe 6.5 to 7%. But when you're watching TV or you're reading about what's going on in the market, you're seeing, well, the S&P is down 15%, or the Nasdaq is down 21%, right? These are huge numbers, but it's really important to put in perspective. That is not your experience theoretically. That is, what one part of the market is doing at that point in time.
Yeah, absolutely. So I think it's important to look at this and say, well, why did some of these things happen? And first and foremost, one of the big things as to why our clients' portfolios didn't necessarily see what the overall market was experiencing was because of bonds. Bonds are traditionally more stable. When markets are scared, they tend to push money into bonds, kind of that stability of the market. They produce just nice income rather than having the volatility of equity markets. And so that definitely helped buoy the overall 60-40 portfolio as we're seeing these tumultuous markets. But the other thing that happened is that, well, a lot of this complexity or this fear that happened in the market was kind of isolated to the US. I mean, for obvious reasons, a lot of this was really pushed in by the Liberation Day tariffs, kind of the unknowingness of what was going to happen thereafter. And so we saw international markets kind of act somewhat as a safe haven, but also as a place where there was continued growth when the US markets were going through this instability. So let's go ahead and look at this next slide here. And this is what we're kind of showcasing here on this slide. So we're comparing the U.S. market to the international market over a long or over the year-to-date time period that we're just looking at on the prior page. And so you can see here that that blue line, the U.S. market, had that drop. It had that negative 15% drop in the market right about April 8th was the worst time in that market. And we can see that international markets also experienced something similar, but not nearly to the same degree as international or as the US markets have that drop down. And we've seen that theme play out so far throughout this year. And so we can see that in the current, or as of June 30th, the year-to-date performance is basically tripled in the international market compared to the US market. And this really goes to show why simply saying equities in general maybe isn't looking at the whole picture, because underneath stocks or just equities as a blanket statement, you have so many different companies that are geographically diversified, that are diversified across different sectors, that are diversified across different business sizes. There are so much going on underneath the hood that kind of leads into why a lot of what our clients see inside their portfolios might not necessarily exactly match up with what you're seeing in headlines. And this really just goes to show why we've seen those 60-40 portfolios, well, as you saw on the last page, are actually beating out the S&P 500 year to date, which is not very common. But in these down markets where we see just some really temporary shifts in the market, it can really show a big benefit over time.
Yeah, and I think one of the things we saw at first was, this outperformance in the international markets was first largely driven by what we would call the developed markets. So, Europe, the UK, Japan, Canada, the developed world was really driving a lot of the growth, whereas the emerging markets were sort of trailing behind. But now if you look year to date, I mean, both of those sectors, both the developed and the developing world, are really driving some growth in the equity space. And I mean, I think there's a fair number of reasons for that, some of which you might even just say is sort of international markets catching up, so to speak, with the fact that they haven't performed as well as U.S. stocks in recent years. But I think also, the devaluing of the U.S. dollar relative to other currencies has boosted international equity performance as well.
Yeah, especially in a very tech-heavy U.S. Marketplace. Internationals have also been a place of having diversified stock exposures outside of just that one singular sector. I want to say 28% of the U.S. stock market is in that one singular sector. When there are 8, 9, 10 different sectors to be focused on, there is quite a bit of concentration in that technology sector alone here in the US. So international markets help beyond just being geographically diverse. You also get further sector exposure as well, different types of returns. There's a lot more to it than just simply being overseas.
My clients are sick of hearing this from me, I know, but this is why we remain diversified in your investment portfolio. Exactly. This is where it actually shows and shows up. So they're sick of hearing that from me, but this is
it's good to see because, for the last, whatever it's been, 20 years or something like that, you might as well have just bought the S&P 500 and not paid any attention to internationals really, because that's been the biggest performer. But it is good to take a victory lap of this is why we stay diversified, because that will change at some point. Not that it's going to be a long run for internationals outperforming US or anything like that. It's just, this is how markets operate, is that eventually things do switch a little bit.
All right. Well, that's enough on the market. I think that the economy has been an interesting place to be.
It has, yeah. So we've been talking about this for quite a while now, that the Fed is just towing this line because they're getting so many different data points, and you can see conflicting sides to everything that they're kind of seeing in different spots of the economy and things like that. So The economy is still strong, though. The inflation numbers came out just the other day here. Inflation was pretty much in line with what the market was expecting. So this is, why we always say the market doesn't like uncertainty. And so when you get data that is either better than the market anticipated or worse than what the market anticipated, that's generally where you're going to get the moves in the market because it just didn't hit expectations. So even though, it came in basically what was expected at 2.7, I think it was 2.9, 2.7, something like that. It was basically what the market was expecting. So that's why you didn't see a big swing or anything like that, because it would be more of an issue if it was a big surprise, either good or bad, because of where our economy is right now in kind of a fragile state, meaning that if the inflation was going down too low or going up faster than anticipated, that's going to change the market's expectations for where interest rates are headed. So right now, the market is still predicting 1 or 2 interest rate cuts. So if inflation were slowing down significantly faster than anticipated, that might cause the Fed to do more than 1 or 2 rate cuts, which would, again, throw the market into a tizzy kind of thing. So there's just so much data right now that it seems okay underneath everything, but it could turn quickly. And so that's why everyone is just a little bit kind of wait and see how this all plays out, because nobody wants to make a big bet one way or the other. But like I said, job numbers still continue to be strong. And then, like I said, inflation's coming back down. So the Fed really doesn't have a huge need to make any massive moves at this point. That's kind of why they're still in this wait and see mode. It'll be interesting what happens if the data just continues to kind of stay where it's at, because we're really not that far off of the long-term historical Fed funds rate. So it's very possible that we only get 1 or 2 rate cuts and it just holds there for a prolonged period of time. So we've been kind of used to this artificially low interest rates for so long that we all think that's normal, but actually where we're at is not that far out when you go back over a longer period of time than just the last 15, 20 years here. So, and the good thing with the economy too is as long as people have jobs, they tend to keep spending money, they tend to buy houses, they buy cars and all that kind of stuff. So even if you do see some certain parts of the economy slowing down and things like that, as long as the majority of people have jobs, they're going to keep the economy kind of chugging along. Is how it works.
Now, before we had large inflation happening from kind of the rebound of COVID and the supply chain shift, you really saw a world where we had lower than average or below what the Fed's target rate was of 2%. It was hovering around anywhere between 1.6 to 1.9 for a long period of time. And the whole conversation was focused on, are we too low? Do we have room to move it above 2%? Obviously, maybe overshot that just a tiny bit. But now,
I'd say that.
Kyle, to your point, we're hovering right above it. We did have an uptick in inflation on the last read a day or two ago. But it has been in line with expectation, and it's not far off from the long-term rate of 2%. And to be a long-term rate, you kind of have to be above and below it. And so showing it this far off, that's maybe not as far off as it needs to be. And it's been interesting to see kind of the conversation around how tariffs are kind of playing in with that and how the Fed might need to hold off for a little bit just to see how those play in. It'll be interesting to see how that takes frame over time. But it's gonna take a bit of time. It's not gonna happen right away. We're not gonna have an answer in a month or two on, hey, we need to raise or lower rates because of the impact here at this point. Unfortunately, it takes a while for tariffs to kind of get into the global economy and see how that impacts both the U.S. and international markets.
All right. Yeah, so again, this is kind of just an illustration of what we were just kind of talking about here. This is, 40 years worth of data essentially, in that there's periods of inflation being below the Fed funds rate, there's periods of the Fed funds rate being above inflation. But again, the long-term trend is we're not that far off of it. So I look at that right just back in like 2020 there, you can see where the rates were super low, and then all of a sudden the Fed funds rate got spiked up. So that was the whole 2022 kind of market reacting the way that it did. But now that it's kind of, obviously they've reduced them in the last year, now it's holding steady. So we'll see how far that continues to fall. But like I said, historical average, we're not that far out of line of what you would see over a long period of time. And again, they've said this from the beginning, they're going to be very, very data dependent. But that data, it depends for the market as well, because you can say that, okay, what would cause the Fed to cut rates? Well, if we have a big slowdown in inflation, or we have a big job unemployment number come out, that could be signs of, yeah, the Fed needs to cut rates, but that also could mean that we're heading into a recession or something like that as well. And the market's going to front run that too. So like I said, we're just kind of all in a wait and see kind of game right now. And this, again, we don't know exactly how all these tariffs are going to play out either and what that's going to look like. So it's really, everybody's kind of waiting around to just get more data and see how things play out, as I said. So,
yeah. Typically, we wait to the end for some of the questions, but I think a really good question just popped through here. So we have the question here. I thought that the last CPI showed a worrying upward move. Knowing that it's not the whole rate with how kind of tariffs could impact that, but kind of wondering, being at that 2.7 to 2.9, how does that impact the overall kind of view of it? And Kyle, I think you said it perfectly that really when we look at the whole how things are playing out, one, we're not as far off as we used to be. The big fear is that you're well above 3% or in 4% inflation, and things start to spiral away as wage inflation or people's wages increase to kind of combat inflation, but then that spirals into increasing inflation because consumers are demanding more product. At certain levels, it can start to get much more worrying. But as we're getting closer and closer to that 2%, it starts to stabilize out a little bit more. The big worry here is how tariffs are going to play into it, if they're going to have a large impact. The Fed's come out and talked about how is it either going to be a one-time spike, or is it going to take a longer time to have it play in, and it's going to have a longer impact, keeping inflation raised at a longer period of time. We don't know the answer. The Fed doesn't know the answer. It's going to take time to see how companies integrate the tariffs that are coming through, if they're going to be passing them off to consumers, if they're going to be taking those on themselves. They definitely have the margin in some cases to be able to take on those tariff rate increases. But unfortunately, it's going to take time to see how inflation plays out. The Fed is taking a relatively smart move by not going and decreasing rates very rapidly.
Yeah,
maybe they'll reduce rates at some point this year, but they're waiting to see that data dependence is a very important stance to take on it.
And I think the cautious approach is something that in recent years the folks at the Fed have learned is really important, because the impact we think certain events will have on different parts of the economy just don't always come out to be that way, right? And they don't want to be bumping up rates and then pulling them down and just being very wishy-washy on that, because it doesn't. I mean, these are large changes and impacts to the economy, and I don't think we're saying that tariffs certainly aren't having an impact on inflation. I think what we're saying is it takes a while for things like that to work their way into consumers' everyday lives. And the jump from of 0.2% on a monthly inflation reading, it's hard to say where that came from or what directly impacted it. So it's really, I mean, I keep hearing us talk about this over and over, and it's in some ways I think unsatisfying, but we just don't have all the information we need yet to fully understand what the impact is here.
Yeah, I will say, digging a bit deeper into this latest inflation reading, a lot that was talked about on it was really around kind of the headline inflation number, which has two really key critical things that dramatically impact the rate, both food and energy. And those can kind of really impact the overall number when they have tiny little spikes that happen in certain months. And if I remember it correctly, we had a month-over-month increase of 0.9% in energy, which really kind of pushed that number a bit higher. course, it was in line with expectations, so it was somewhat known that that was going to happen. But when you strip those away and you take that out, I'm going off memory. I looked at this number a couple of days ago, but I want to say core inflation, which takes out that food and energy volatile impact, we're sitting at about 2.3%. On an annual year-over-year basis. And so that shows kind of when you strip out some of these things that jump around a lot, and we're looking at that core inflation price or number that we need to be paying attention to, we are kind of getting closer to that 2% number. We are still having some bigger items underneath the hood of that are keeping that number above 2%, one of which being rent increases year over year is continue to stay higher than what we traditionally hope it to be. But that makes up a large proportion of what overall inflation is experienced for people in the US. So that number is one to kind of pay attention to. And that's one that we've shown before, one that we can pay attention to.
Yeah, it's really interesting because there's two main areas of inflation that are sort of those sticky inflation parts of the CPI, and it's that shelter cost, and it's the cost of property and casualty insurance, your home and auto insurance and liability. I hear this from clients all the time. I experience it myself. These premiums have jumped a lot in the last couple of years, and that is also a contributor to that inflation reading that we get. So parts of the basket of goods of CPI are coming down, but they're also offset by some of these other stickier parts of it. All right. Well, we try to, on these webinars, spend a fair amount of time talking about what's going on in the market, but then we always try to pull everybody back to how this impacts the day-to-day and your financial plan, because that is a big focus of what we do here at Klaas. And so what I wanted to spend a little bit of time here talking about is the tax and spending bill that was just passed by Congress and signed by the president on the 4th of July. I wanted to talk through a little bit about what's actually in the bill and what of all of the sort of headlines about the bill, what does that actually end up meaning for our clients? And there's a ton in the bill. We're not going to go through all of it today, but we tried to pull out some items that are especially pertinent to the folks that we work with.
Wait,
so
Eric, you didn't read the whole thing?
No, I did not. I got about 3/4 of the way through, and I'm just kidding. No, there's a lot in there. There really is. I think as our political system continues to be very polarized, they cram more and more things into these spending bills just because it's a one-time effort to get everything through and not fight over it. But I want to just start by at a very basic level, what does this new tax and spending bill actually do at its core? And what it does is it makes permanent the tax bracket changes, as well as changes to the standard deduction that were brought about in 2017 with the Tax Cuts and Jobs Act. So what that means is rather than sunsetting at the end of 2025 and reverting to the old standard deduction and the old tax brackets, those were made permanent here with the tax and spending bill. Another big part of it is the SALT cap deductions. So SALT stands for state and local income taxes, and the Tax Cuts and Jobs Act of 2017 actually limited the amount that could be deducted as itemized deductions for taxpayers. So the cap was $10,000. It limited the amount of state and local income taxes that could be deducted as itemized deductions. That has been increased to $40,000 under the new bill. So basically, with the Tax Cuts and Jobs Act, they increased the standard deduction and then limited the amount that you could actually write off at the state and local level. So as we move forward here, we may see some people shifting back to that itemized deduction rather than the standard. But we'll see as this moves forward. But that's one of the big changes. There's also this idea of what we call senior deductions in the new bill, and what this is an additional $6,000 deduction for taxpayers over 65. Okay, so this is available whether or not you use the standard deduction or itemized deductions, and it's just an additional tax deduction for taxpayers over 65. This is scheduled to, under this current bill, this would last through 2028. So a lot of the changes are limited to a shorter period of time here. But the senior deduction, like I said, is that additional $6,000. Now, one of the headlines we have seen in the sort of, I guess you could say, the marketing of this bill is no tax on Social Security. I would argue that is a oversimplification of what the bill actually does. And the Social Security Administration did send out an email that has received a lot of blowback for perhaps not being quite as clear or as accurate as we might like. But what actually ended up happening with the bill is there's no fundamental change to the way that Social Security is taxed. Social Security is still taxable the way it was before, which, depends on at the state level, depends on your state. The state of Wisconsin does not tax Social Security, but that is not changed. At the federal level, you can still be taxed on up to 85% of your benefit. So there actually was no change to how they calculate taxes on Social Security, but that senior deduction is seen as, because it's providing a $6,000 tax deduction for folks over 65, they're sort of using that as a way of saying that they're not taxing Social Security, because you would have a larger deduction to lower the amount that you would actually owe on your Social Security. So an oversimplification, I might say there. Another big part of this, another big headline was no tax on tips and overtime. So this was another piece that made it into the final bill. So let's start with tax on tips. So this is again set to run through 2028. Would have to then be renewed. The tax on tips, you are allowed to deduct up to $25,000 of tip income. Now, this does not eliminate the payroll tax, so your Social Security and your Medicare tax on the tips, that still applies. This is specifically an income tax deduction. So you are able to deduct up to that $25,000 per year. On overtime, this also is subject to that 2028 end date. And this allows a deduction of up to $12,500 per year, or $25,000 for married filing joint couples. And the interesting thing about this is it only allows a deduction for the portion of your overtime pay that is over and above your normal wage. So let me give you an example here. If your overtime rate is time and a half, right? So you're basically making, for every hour of overtime you work, you're getting paid 150% of your regular wage. The 50% that is over and above your regular wage is what is allowable for the deduction. Okay, so again, that's capped at $12,500 per individual, $25,000 for joint filers. And again, this does not eliminate the Social Security and Medicare payroll tax that would be due. So it's strictly an income tax deduction. And this is I believe I said this already. This would expire in 2028 if no changes were made. So on the other side of it, on the other side of the coin, the other side of the coin here, if we're cutting a lot of income taxes, we theoretically should have some cuts to government spending to offset those tax cuts. So one of the ways that it is expected this bill would be paid for would be with a reduction in government spending on healthcare. So the expectation is that about $1 trillion over the next 10 years would be cut from spending from the federal government on healthcare. So the two main programs that this would impact would be Medicare and Medicaid. I'm going to start with Medicaid because that's, I think, the more direct impact from this bill. So remember, Medicaid is health insurance for low-income individuals. And one of the things that the bill does is it limits or it creates new eligibility requirements for folks to qualify for Medicaid. And beyond that, because Medicaid is a federal and state partnership program, so the federal government covers a portion and the state government covers a portion, there are some new limits on the ways that the state can actually fund their Medicaid program. So in theory, if the state has limited ability to fund their Medicaid program, then the federal government would have less dollars to match. So that would be sort of the direct impact on healthcare. With Medicare, which is again health insurance for folks 65 and older, it's really more of an indirect impact on the program. With the lower Social Security income tax that's generated due to the senior deduction, there's just essentially less funding for the program. And finally, gosh, you guys are just gonna get sick of talking or listening to me talk about this, and I promise this is like a sliver of what is in this bill. The idea with a new piece of legislation is we hope that we are actually able to pay for the cost of the bill. So the last topic here is the federal deficit. So despite the health care spending reductions, the nonpartisan Congressional Budget Office estimates that this tax and spending bill would add about $3.4 trillion to the federal deficit in the next 10 years. So don't love that piece of it from a fiscal responsibility standpoint, but that is where we sit as of today. Mm-hmm. I'm sure everyone didn't expect they were signing up for a tax crash course, but these are the things we felt like were the most impactful at the day-to-day level.
Yeah, Eric and Kyle, I assume you're getting lots of questions about this. I mean, it impacts the financial planning that we're doing in the years ahead, right?
It does. That's why I wanted to talk about it, largely because I'm talking to a lot of clients about this, specifically as it relates to taxes on Social Security.
Mm-hmm. Yeah, that and the two places where we have offices have high property taxes as well. So many of our clients could be impacted by that SALT cap deduction as well.
Yep.
All right, perfect. Well, let's go ahead. We have a couple of good questions that have been popping through, so we'll go ahead and run through a few of those now. Actually, we have quite a few of them that are regarding tariffs. So I think this is actually really wonderful because all of these questions come from very different perspectives. So I love it. Let's try and answer these in kind of a logical order that kind of progress into each other. So the first one that we have here is, can anything good come out of the Trump tariffs? And again, we'll try to stay pretty apolitical on this. So really kind of the short of it is that, yeah, I would focus on two primary things that can be benefits out of tariffs like this. One of them, of course, is revenue. I just saw a day or two ago that in the first quarter that we had these live, which was Q2 of 2025, I have it written down here. 64 billion in revenue was generated from tariffs. Now, you always have to compare that to previous periods. So it was up about, I want to say 45 billion compared to the same period last year. A lot impacts this. I haven't been able to look at the numbers underneath the hood. The information hasn't been released yet on that. Um, so we're not really sure how much of the implemented tariffs impacted that number,
Right.
but it has been on the rise. So purely from a revenue standpoint, yeah, it's absolutely increased revenue. Now, on the other hand, this is one of many, many tools that you could implement to kind of encourage this outcome. But another impact that can happen is kind of reshoring of jobs that went overseas. You have situations where manufacturing plants might be opened up in Mexico for the auto industry. You implement tariffs that can discourage of new manufacturing plants over in Mexico as that increases the core costs of those products. Well, that might encourage companies to either open up new factories here in the US to help bypass some of those tariffs, or they might not open up manufacturing plants outside of the US in the future. Is this the best way to go about doing some of these things? I don't have the perfect answer to that, unfortunately. But when you ask the question of, is there anything good that can happen out of this? Well, yeah, there absolutely are good things for the US that could happen to that from implemented tariffs. But it's not always clear how much benefit there is, and if in the overall picture of things, if that is clearly a perfect resolution to how things are happening here in the US and from a global standpoint as well.
Yeah, I think I would add, I mean, when you look at a policy like this, are there any positives that could come from it? In a perfect world, absolutely. Every policy idea is going to have, some pros and some cons. It's about balancing how much is on the pro side and how much is on the con side, because it's not necessarily a free lunch here. If we are increasing the cost of items that are currently lower cost, it then in many cases will fall to either the company providing the product or the consumer to pay higher prices in the meantime. And things like, shoring of factories, we can't unfortunately just do that overnight, right? We take some time to build that infrastructure and get to a point where we determine, can we actually afford items that we make here? Who knows, right? There's going to be pros and cons on both sides.
Mm-hmm. All right. So the next question that we have on tariffs, why are the markets not reacting to new tariff threats? And I think this is a good question, and one.
It's a great question.
As you're hearing similar things come out as what we initially went through Liberation Day, it's interesting to see the markets kind of take it in stride a bit. But I would really kind of go back to kind of Liberation Day when the initial tariffs were brought out and kind of announced. It's kind of a kind of almost gut punch to the markets. The market expected that there was going to be some news about tariffs coming out, but when it got released, the market wasn't expecting how significant the tariffs were going to be. And so when they were brought out, it was really viewed as this actually could happen kind of a picture. And we talked about this in great length during our last meeting. But as we've seen this play out, as we've seen the market recover, it's really been viewed as, okay, this is how it's going to be rolled out. Some of the rates that have been talked about have been backed off a little bit. One example that I have here, Vietnam, for instance, started at 25%. It was talked about being raised up to 46% for the tariff rate. And now it's been verbally confirmed that it's going to be brought down to 20%. So we've seen that this is one. There's been a lot of variation of where tariff rates are going to end up. And then secondarily, this has been a lot of negotiating. So rates are brought out, and then they're discussed, they're negotiated with all these different types of countries, even in just different industries specifically, or very specific products that a country specializes in. The market has had time to kind of digest what's happening, how things are going to play out, and it really has taken in stride. The economy is still strong, still stable. We've seen the job markets have a little bit of fluctuation, but for the most part, really handle everything well. And that's kind of where we're at. We're in a place where the market is able to understand this. They know kind of what's going to happen, even though things are still fluctuating and about. There isn't that fear that every single country that we partner with is about to get hit with a 25, 40, 50% tariff. It's generally known kind of where things going to play out, and that for the most part, there's a lot of negotiating happening with every single country that's out there.
Yeah, and the market trades on expectations, right? So the level, or where the market is a function of what traders as a collective expect. And I think it would be reasonable to say that at this point in time, the market does not expect excessive tariffs to be implemented, right? And the reason why, in general, investors think that is less important than the general consensus, I think, of the market. And a lot of people are saying, even with the implementation of some of these tariffs, there's also the flip side of that, pushing the market forward, that we just had a tax cut for businesses, right? So that would theoretically add to profits for businesses, which in turn makes stocks trade higher. So tariffs are one piece of it, but it's just one piece of it.
Mm-hmm. All right. Let's go ahead and we'll consider the tariff topic answered for now. We'll go ahead and jump to some other ones here that are specifically referring to some of the topics that we talked about at the end with the taxes. It's a good question. Holding everything else constant, do you expect your average client to have more or less net income for spending in 2025 and beyond with the passage of the OBBBA?
It's a good question. I think
A very good question.
Again, yeah, we haven't read every single letter of the bill yet, but what it looks like with the increase to that senior deduction of 6,000, which is essentially going to bring most of our clients are receiving Social Security and over 65, so that should in theory reduce their income. And that SALT cap going above up to 40,000, so above 10, that should mean that more clients get to itemize deductions, assuming your taxes are above that $10,000 number. So all things being considered, you probably are going to get a higher net income than what you had before this passed. Again, because of those things that I just mentioned, and also these tax brackets staying where they're at. So before this got passed, all of those tax brackets were scheduled to get reverted back higher. But because they held the tax brackets higher because of that increase to the senior deduction and that SALT cap for the clients that we service, it's more than likely most of our clients are going to see a higher net income than what they had before this.
All right. Then I think this is a really good question because it's a common topic that gets brought up. Honestly, I've been hearing it less and less recently, but it's probably an important thing to chat about.
Yeah.
So on the question here, I saw that the Social Security Administration is projecting the funding shortfall around 2033 or 2034. Do you think seniors collecting benefits should start planning on a reduction in benefits, or do you think Congress and a president will eventually solve this problem before that happens?
I love this question. I get this from clients all the time. I love it because I just get to give my opinion on it because nobody knows, right? But I think this is a perfect opportunity for us to look at the incentives at play here. So if we say, yes, on paper, the way things are set up today, The Social Security trust fund would run out in that 2033 to 2034 timeframe, at which point we then are we essentially have spent down our reserve that we're currently using to supplement the amount that people working are currently paying into the system, right? We have spent down our reserve, so we're just basically able to offer existing retirees the dollars that are currently being paid into the system, at which point we're essentially able to pay about 77% of promised benefits. So I will often ask clients, does it seem reasonable that politicians would expect to be reelected if they were to just cut by 23% the income of one of our most reliable voting blocks, being our seniors? I think it's pretty unlikely if I were to bet on it. I think that it's more likely that we will have similar to every time we have the discussion about raising the debt ceiling, it will feel like an emergency, and oh my gosh, what's going to happen? Are they really going to pass it? And at the end of the day, they'll pass it at the 11th hour, and everyone will breathe a sigh of relief, but we'll get to go on that journey first. I think in general, I don't think that that the current political system would allow Social Security to be reduced. The other piece of it is there are so many Americans that depend on Social Security, and a good chunk that depend only on Social Security. Mm-hmm. So whether or not folks benefit from Social Security to keep them out of poverty, or we have to then pivot to some other program, it just doesn't seem to make sense to rob Peter to pay Paul in that situation.
Yeah, and they have levers to pull, and they've used them in the past too, which I think is important, right? So the two biggest levers that are would be the easiest, I would think, for them to implement would be to push the full retirement age back, which they've done historically. Right now it's 67, and your benefits grow up until age 70. You guys hear us talk about it a lot of time. They very easily could push the full retirement age up to 70. I shouldn't say easily, but they've done that in the past. They've moved it from 62 to 65 to 66 to 67. So that would start refilling the coffers. And the other big one is the Social Security taxable wage base is currently $176,000 right now, meaning if you make more than $176,000 for the year, you don't pay into your Social Security above that. So they could easily increase that taxable wage base, and that would get a lot more money flowing into the system as well. So I agree with you, Eric, that I think it's just a matter of time and who's going to sit down and figure it out and push it through. But it's I would say, very, very likely that they're going to make some tweaks to it and will keep benefits solvent, because as you said, that's their good way to not get elected, is to tell seniors you're taking some money away from them. So.
Perfect. Thank you. All right. Well, I know that there's a few extra questions that we have in here, so we apologize we can't get to every single one of them. We will have to close it out there. But thank you very much, everybody, for joining us this quarter. We'll be back again, September, October. We'll chat again and hopefully have a few more answers about some of the things that we talked about today. Thanks so much for joining us.
Hey guys.
Bye.